Right, welcome everybody. Contrary to what it might say on your screen, as you probably guessed, I am not Hannah Crowe. I'm Andy Edmond of Equity Development, and thank you very much for taking the time to join this event. A very potted history is, in recent weeks, there has obviously been a lot of attention on taxation. The Chancellor has a £500 billion hole to fill in coming months. And at Equity Development, we wrote a little piece ahead of the mini budget about the dangers of tampering with some of the tax incentives that have certainly helped the AIM market contribute considerably to employment and economic profitability, which I'm sure Marcus will pick up on shortly. And since then, of course, we've now had the OST asked to look at capital gains tax. There's rumours in the papers regularly about wealth tax. We're not going to be able to comment on all that. But what we do hope to do today is talk about the value of SMEs, the value of AIM, and between us, hopefully come up with one or two constructive suggestions about how taxes might be amended to keep that success going. I am fortunate to be joined by a very distinguished panel who know far more about these topics than I do. In no particular order, we have Dru Danford, who is the head of corporate advisory at Shore Capital and has been for many years. And of course, Shore Capital is not only a leading broker in the SME space, they also operate the Puma investment arm. We also have with us Jourdan, who was one of the co-founders of Amati and is now the CEO. And Amati has a long, distinguished record in SME investment and, of course, looking at IHT investment as well. Last and certainly not least, we have Marcus Stuttard, who for also many years, we're all showing our age, has been the head of AIM and is also now the head of UK primary markets at the London Stock Exchange. And I think, Marcus, we might well start with you to talk a little bit more about how AIM is flourishing. Congratulations on its 25th birthday. And I'm sure that you have a great perspective about how good and simple tax treatment has helped the exchange, as well as the dangers of perhaps tinkering with it too much. So over to you.
Thanks, Andy, and good afternoon, everyone. So I'll just spend a couple of minutes setting out a bit of context. Well, I think many of you will know the background to AIM. As Andy mentioned, AIM celebrated its 25th anniversary last month, so that was a great opportunity to celebrate a lot of what AIM and the AIM community and the entrepreneurs that have used the market have achieved over the years. And I think particularly over the last 4 or 5 months during the pandemic, AIM and equity finance and public markets have really come to the fore and shown their benefit. I think both AIM and the main markets in terms of supporting a very broad range of companies from micro cap up to FTSE 100 and investors really supporting further issuance has demonstrated that ongoing access to capital and liquidity that the markets can provide. But if I focus in on AIM specifically, over 3.2 billion pounds has been raised year to date in over 200 transactions. And to give you some sort of European context, that represents about nearly 70% of all of the funding in total on European growth markets. So, as we know, there is a scale and a maturity around AIM that really just doesn't exist around many other growth markets globally. And that's in large part because of the depth of the pool of capital that sits behind AIM, but also the breadth of the advisory community. But we don't, as London Stock Exchange, view AIM in isolation. I mean, I feel very strongly that having a market like AIM has a big impact right the way through the funding escalator or the funding ladder, or however you want to describe it, because it's clear that whether it's friends and family or angels or venture capitalists are a lot more likely to invest in early stage businesses if they know that they've got a range of of exit and further capital raising options. And AIM is a very important part of that. So, when we talk about some of the tax breaks that apply to private companies as well as AIM quoted businesses, to my mind, AIM plays an important role to sort of amplify the benefit of things like EIS, venture capital trusts, business property relief, because whilst a lot of those tax breaks are aimed at providing or filling gaps and addressing market failures for private businesses, to have AIM and to enable those companies to continue to grow clearly amplifies the benefits of those tax breaks at an earlier stage. But there are also very significant benefits to being on AIM for a company itself. And as part of the 25th anniversary, we use the opportunity to run some analysis about the economic contribution that just the UK incorporated companies have on the UK economy. And that research that was conducted by Grant Thornton showed that in 2019, which is the kind of latest available data, the UK companies alone contributed £33.5 billion to UK GDP and 430,000 jobs directly. Now, if you include supply chain impacts and multiplier effects, those numbers raise to a £67 billion contribution to the GDP and nearly 900,000 jobs, and a tax contribution of £3.2 billion. So these are big numbers, and so we've got empirical evidence about the broad macro benefit of having AIM in the UK. If we look a little bit more specifically at the companies themselves, that same piece of research validated things that we already knew around the fact that AIM companies tend to be more productive than their private company peers. They have revenue growth that's significantly higher and profitability that's higher than their private company peers generally. And also that research showed that AIM companies are twice as likely or generate twice the revenue from exporting as private company peers. And to my mind, a lot of that comes from the fact that these companies are better capitalized, they've got better advice because of the advisory community that supports the market. But equally, revenue growth post-IPO runs at about 40% in general for AIM companies. So, AIM and equity finance that goes into those companies really helps to either accelerate or sustain their growth. So, there are some very strong drivers here and evidence about why AIM and AIM companies make a very strong contribution to the UK. And I think, one of the misperceptions sometimes is that because AIM is a London Stock Exchange market, that it, primarily supports, companies in London and the South East. But actually, there's a good broad spread of regional businesses on AIM. So, for example, there are about 107 AIM companies based in the Midlands, valued at nearly £17 billion. 43 in the Northwest, nearly 20 in the Northeast, over 25 in Scotland. So, whilst I think there's always more to be done to develop some of those kind of regional aspects, actually there is a very wide base of both investors and corporates regionally. So, hopefully, Andy, that provides just a bit of context, and I think we'll probably come on a little bit later to talk about the size of the future opportunity and the fact that, I think we all believe that actually more private businesses should be thinking about an IPO or, raising equity finance, and maybe we'll come on to talk a bit about that a little bit later.
Yeah, thanks, Marcus. And Drew, maybe this is a good point for you, because you're involved in sourcing these companies, advising them whether they're ready for public listing, getting them there, and then supporting them. How important is the tax environment around AIM to the entrepreneurs and the company owners that you're talking to?
I think as part of a package, it's extremely important for entrepreneurs, founders of businesses who, the alternative for them is they can go and sell their business to private equity or trade sale, face the CGT tax, if you like, at that point. Whereas, I suppose coming to AIM, you get the continued benefits of some of those tax breaks. And, they've then got the opportunity to stay in and grow those businesses further, taking advantage of all those those tax benefits. I think, the other thing I would say is, looking through the other side of it is that, for investors, and even the retail investors, this is giving people the opportunity to invest in UK enterprise, which, frankly, if a business is sold to a private equity house, that people aren't really going to get the advantage of, to participate. And I think one of the things we need to think about in the UK, and I think tax breaks goes some way to helping this, is, how do we get greater share ownership, just generally, not only entrepreneurs bringing companies to business, to market, but also, the wider share ownership and engagement with general retail investors, so that you get a sort of an ownership culture going in the UK, which I think is fundamental to a very healthy and dynamic economy where people are participating. And I think just picking up on something that Marcus said, I think we mustn't underestimate, in the UK, for regional based entrepreneurs, the benefits of coming to market. And it really does professionalize their business in a way that, if you're keeping a business private and just, I know that when you sell to private equity, you get very different engagement with those private equity investors. But, I think when you come to market, the transparency and the ability for a business to really transform itself and in a way put itself into the public arena can actually help their business as well. And really, you just take a few examples, Fever Tree really came and used the public markets as part of its almost branding and made it sort of a global brand. But, coming to market helped. So I think, all these things together, I think from an entrepreneurial perspective, it's really important. And then just finally, I think, one thing about all these arrangements is, they're quite well known. And I think to start changing things, you've got to be very careful about what you might look to do, because you want to keep things, as constant as possible, because if you're constantly tweaking arrangements, it doesn't really build a sort of the ability for people to plan ahead and think, well, that's the option that I can count on, and those tax arrangements are actually there to stay. I think that's quite dangerous if you start playing with them without looking at everything in the round.
Right, I think that's a very fair point, and we're not here to talk about capital gains tax, but you just have to look at the complexity and the huge array of allowances that are available, which makes it harder to police and probably easier to dodge as well. So I think a fair point. Now, Paul, you're sitting there very patiently. What about the other side of the coin? What is an investor looking at when a company is thinking of coming to AIM, and indeed wants it to arrive there?
I guess what an investor wants to see with a company arriving on AIM is a degree of maturity about a business. So we don't float startups, and if a company tries to float too early, then that can lead to a lot of problems. So choosing your moment to float is quite important. I mean, if you're an entrepreneur wondering what that moment might be, perhaps a good way of looking at it might be, depending on the kind of business you are, but it might be that at the point at which your business becomes forecastable, and you can, with some degree of certainty, well, not certainty, but some degree of reliability, say, okay, this is a realistic set of expectations for the earnings of this business over the next 2 years. Then you've maybe reached a point when that you could usefully be on the market. I mean, that's for a group of businesses clearly, one of the interesting and dynamic qualities of AIM is that it's also does support companies which are, if you like, are more speculative than that, so they don't necessarily have a mature business that's up and running and profitable. So the market is willing to be quite forward-looking, but you do need something definite, distinctive, and key properties of the company which they really own an area. So if you don't have a predictable revenue stream and profit stream, you need to have some very strong IP and a very well-defined market which you're going to go after. So you need enough about you to float, and from our point of view, that's one of the it should be one of the virtues of the public market. Of course, the things that are on the public markets need to have been pretty thoroughly vetted by somebody, and this is a complex process on AIM because it involves clearly nomads, the nominated advisors to the companies who are responsible for a lot of that vetting process, and that leads to a lot of questions over who are that group of people who are nomads, that, you know, the gateway to the market. It's rather different on the full list, where you have a more central regulatory function which is doing that kind of checking. But, you know, clearly you also have a lot of lawyers who will be advising companies on drafting their documentation, verifying statements. And I often say to people, you know, for a company to float on AIM, it requires due diligence to be done that probably costs £200,000 or more. And so, you know, there's a very thorough set of processes that go on. And what you end up with is completely different from a private company, where if you want to invest in a private company, you know, you need to replicate that level of due diligence yourself, or else you're really, you know, obviously if you're backing friends and family, it's maybe a bit different, but you're really taking a massive leap of faith, which you shouldn't necessarily be taking with a public company. This is the whole point of public markets, is they're designed to build trust. And so, I mean, just rewinding a little bit to some of the points, bigger points Marcus was making about AIM. I mean, I think that the 25th anniversary is very significant, and, you know, anybody thinking about making policy in relation to AIM and saying, oh, we think this should happen or that should happen, needs to remember that it's taken 25 years to get to where we are. And this has been a long, windy road. You know, I've lived with the market for 22 of those 25 years. You know, I first started meeting AIM companies in 1998 when I became a fund manager. You know, this has been a difficult road. You don't just create something like this overnight. You don't create it in 10 years even. You know, this takes 25 years. And I think, you know, the way we should collectively think about it is this is really a national asset, and it's taken a long time to get here. This is complicated. Clearly things go wrong from time to time, and you know, we need processes for examining mistakes when they get made and putting things right. But you know, what I would also say on the other side of that is that over the last decade in particular, this has been a very, very fruitful period for the market. You know, AIM is, you know, of that 25 years of progress, a disproportionate amount of it has been made in the last 5. And, you know, and 80% of that progress has probably been made in the last 10. So, you know, it was a long road to get here, but, you know, now we've got something very fruitful and it's making great strides. And what we now have a situation where the leading companies on AIM are great businesses. And you couldn't say that 15 years ago. The leading companies on AIM were flaky and unreliable and a bit all over the place back then. And, you know, that's why it takes a long time to get the processes right, for the entrepreneurs to get the trust to use it, for people to learn how to use it well and properly. And so I think it's something we should be celebrating. And I know we're here to talk about tax. You know, part of that journey has been created through the tax reliefs put in place by successive governments, Labour and Conservative. So this is not a party political thing. You know, this goes right across the political spectrum. It's taken a kind of, you know, a cross-party effort to get where we are, and before making any changes, we need to think, you know, very carefully about that.
Yeah, I think that lots of points resonating already about not acting in haste and regretting at leisure, thinking things through, and I'm sure we'll keep coming back to not damaging the underlying asset, which is the SME community. And I noticed you very politely laid some of the early teething problems at AIM long before Marcus arrived there, Paul. So we might sit back to you, Marcus. Let's keep it on tax just for now and BPR. I think I know from what you and Dru were saying that you might like to see a little bit of tinkering about the edges, but not a removal of the entire relief offering from the government, of which AIM is, you know, only a small part.
That's right. So I mean, it's worth just remembering, Andy, that, you know, to the point that Paul made about successive governments, you know, there have been multiple reviews in the UK around how do we support scaling businesses, going way back to the Macmillan Review, and then more recently during sort of my time in capital markets, you know, the Rowlands Review, the Cruikshank Review, you know, and we've had some of these really long-term structural issues about how do we support small and scaling businesses in the UK? And so, we have come to a situation with, after a lot of analysis and different iterations by successive governments, of a very comprehensive package of incentives. And actually, I think they sit together, very well. So, you've got EIS to EIS and the VCT structures on AIM. Obviously we benefit from business property relief, which, to my mind, does a couple of very important things. First of all, it allows great businesses to continue to grow, and for the management teams of those businesses to deal with, succession planning and retirement issues. We've got a number of founder-led businesses on AIM that probably wouldn't be there if it wasn't for business property relief. And similarly, we've got a number of businesses with very strong family ownership in their heritage that might otherwise have been sold. So I think that's one key benefit. BPR really allows companies to continue to grow and to graduate onto the public markets. And as Paul was saying earlier, it prevents that sort of cliff edge where otherwise a company might be sold and all the tax planning would be done just at that one point. And it then allows families to continue to have the economic benefit but not necessarily be involved in the running of the business. And the other really important benefit to BPR is that it improves the overall quality of the market. For any market to be successful, but I think particularly when we're talking about small and mid caps, you need a broad range of investors. You need individuals, and there was a reference to primary bid earlier, and the importance of democratizing wealth creation. We've seen over the last few months the vital importance of retail investors, not only to support further issues and capital raisings, but also to provide vital liquidity to the market. And BPR plays part of that role. It enables predominantly high net worth individuals to allocate a proportion of their portfolio to small and mid cap businesses that probably would be allocated to less productive assets, whether that was equity trackers elsewhere, or whether it's invested in profit or in property or less productive assets. It comes into AIM because of BPR, and it creates kind of good quality long-term liquidity to supplement the daily liquidity that a lot of retail investors provide, and then the longer-term capital provision that comes from the institution. So that mix improves market quality. And that was has been recognised in a number of conversations with Treasury, HMRC, government. When we've talked to them about the importance of liquidity to reduce the cost of capital for issuers, because without sort of doing economics or public markets 101, clearly institutional investors are going to be less willing to invest in a company that's less liquid, or they will require a bigger discount to invest, and therefore the company's cost of capital goes up. So one of the drivers behind, for example, government abolishing stamp duty on the trading of AIM shares was all around improving liquidity, improving the quality of the market and the size and diversity of investors. And that's a very similar role to the role that the business property relief plays. So it brings in investors, it supports long-term liquidity, and ultimately it reduces the cost of capital for issuers. But it also, it means that companies stay on AIM and they grow. And so, as Paul was saying earlier, we've got some very big, well-known household names on AIM that might possibly, otherwise have gone to other markets or have been sold or have transitioned much earlier to the main market. But AIM now is a market and a home in its own right. And so that package of BPR, stamp duty, the availability of shares for individuals, ISAs, but also the sort of the primary capital focused tax breaks, so EIS and VCT, come together to collectively form a really important package. And I think there's a real risk of either sort of tweaking that package and unsettling the whole dynamic, or indeed just creating uncertainty. And that's, hopefully why we have seen in things like the government's response to the patient capital review and the OTS review of business property relief, some very strong statements from government about recognising the importance of growth markets like AIM and the role that the tax breaks play.
Yeah, well, as we all know, there's a lot of support in helping government, as well as there are vested interests that perhaps not thinking of the many but the few. And you raise a couple of important points there, notably the secondary market and retail interest. And with thanks to other supporters of the cause, such as ShareSoc and QCA, who I've been speaking to recently, and they've been talking to their members, and there's no doubt that tax advantages for secondary purchases on AIM is an important, a more than 50% factor in some of the decisions that get made there. So you could indeed be destabilizing the whole edifice. So what about Dru? You said you wouldn't like to see BPR removed, obviously. Are there any more constructive changes you'd like to see in how it's applied on the private or the AIM side?
I tend to agree with Marcus. I think, Andy, you've got to look at it in the round. And actually, I think the package works quite well as it is. I think it's quite well understood. It might not be the most straightforward in terms of sometimes which assets on AIM are BPR eligible. And we often have that debate with some of the overseas companies coming to market. But I think when you look at the package that is available for a proper UK trading company listing on AIM, I think it is quite well understood. And I think reluctant to go down any changes. I guess the one big question we've got to ask ourselves is, do we actually not make all these things more attractive? I mean, I think we have seen recent, probably 5-10 years ago now, so some time ago, quite constraining the ability of VCTs and EIS and which companies they can invest in, and there are various rules without getting too technical about companies that are older than 7 years not being eligible. So, there've been quite a lot of additional constraints. And I think when you look back at those changes, it wasn't really that helpful to actually generating more interest in companies. Because, ultimately what this is all about is, getting capital into companies, and the trickle-down effect benefits everyone, as Marcus set out earlier. So, I think once you start playing with some of these things, as was done with EIS and VCT rules some years ago, I think you can actually end up with some negative consequences. And in fact, if you look at the amount of money that was raised by VCTs over sort of the last 20, 15 years, there's been a marked decrease, because people, or the VCTs can't really find investments, find it more difficult to find eligible investments. But people actually aren't putting as much money into those vehicles because they're just not as attractive. So I think you've got to be very, very careful. And I would shy away from sort of tweaking, as Marcus alluded to, any of these parts of the package. In terms of making it more attractive, I mean, I think, looking forward and all things the UK faces, I think we need to be looking at how do we get more investment into sort of regional areas. Again, Marcus touched on at the beginning, we've got a number of AIM companies in the Midlands, the Northwest, but, are there additional benefits and advantages we can offer those investors that go into, or entrepreneurs that are, if you like, expanding, raising capital and expanding infrastructure, building factories, plants, whatever, in the UK in those regions? Are there additional things we can do to encourage regional development? And will that fit into the sort of overall plan that the government might have post-Brexit? So rather than sort of constraining or, if you like, reducing, I would actually personally sort of argue for sort of enhancing and using various breaks more sort of in a more targeted way.
Yeah, we'll keep coming back to simplicity. I'm not trying to promote competition for Amati here, but it does seem very strange to an outsider of me that you actually have to die to discover whether your investment is in a qualifying asset or not, which is something you'd be agonizing on your deathbed about. But a bit more clarity would open the scope for more IHT funds, more diversity of where they deploy their capital, hopefully a much larger number of AIM companies, once they know whether they're in or not, that would enhance their appeal in the secondary market as well. Fair comment, Paul. You can get more competition.
you either have to die or consult an expensive tax advisor. So one or the other. Yeah, I think I should just say, in answer to Dru's point, because I run VCTs, I'm quite close to the market. That I mean, there were worries that when the government changed the rules, that less money would come into the sector, but actually there have been record amounts coming into VCTs, and more than people thought was going to in the last couple of years. And personally, I was and remain very supportive of the changes that took place to the VCT regulation a few years, but it took place over about 3 years. Some of those changes are uncomfortable still, particularly to do with the age limit on companies is sometimes really unfair on businesses that essentially you start a business, doesn't really work, you try and you change to set it in a new direction, you may not qualify for VCT relief, whereas you would if you'd set up a completely new business. And so there are some sort of random effects like that. But the main thrust of the changes was to really force all people who are managing tax-aided capital to invest in early stage growth businesses and nothing but that. And whereas over quite a long period of time between kind of 2006 and 16, that there was a big mission creep in the industry, which I did personally find distressing and not great. So I was very supportive of the logic of the changes and remain so. Albeit that it'll be lovely to have one or two of the sort of more random impacts of that the legislation looked at to see whether it's possible to keep the thrust of the changes, the raison d'etre of the changes intact, while at the same time making sure that companies which really should be eligible for the support can get it, and so sometimes for not very good reasons companies end up not being eligible, and that is a real pity. And obviously we sometimes come across companies we'd love to fund but can't because they fall foul of a small bit of the legislation. But I also really take Dru's point that I think personally we always tend to solve, we have this increasing problem in the UK. I know it's not increasing, but I've noticed it painfully over the last 10 years. Whenever we want to solve a problem, we come up with a whole load of new policies to do it. And actually so many problems that we have could be solved just by taking what we've already got and running it better. And we don't tend to, that tends to get remarkably little focus, because you don't get many political points by just saying, oh, we actually really like the policies we've got, but we could just run them better. But I think that applies to large areas of our life in the UK. Not least the NHS. We don't need a whole lot of new problems to improve it. It's all about the detail, the real nitty-gritty detail of improving the way it runs, and that applies to many other things. And it has also applied to AIM. That's one reason why it's taken a long time to get to where we are. And I would really echo the points that yes, some of the tax rules we've got are quite complicated. No more so. There's nothing more complicated than the VCT EIS legislation now. But it's complicated for professionals. If you're an investor and you're a private investor on the receiving the tax reliefs, it's broadly pretty simple, especially the VCT legislation. What I really like about it is that it keeps life very simple for the investors. It makes it pretty complicated for us, but we can deal with it. That's what we're here for. And likewise, the advisors on AIM, yes, it can be quite difficult to ascertain. It takes time for the advisors, the nomads, to get their heads around, well, how does this new VCT legislation work? And I had lots of conversations with nomads, and I'm sure many other people did too. And we have got to a point now where there is quite good understanding in the industry of how this legislation works and who to ask for opinions and how to get VCTs to overcome all the hurdles we've got to make a new investment. And I think it's become much slicker than it was a couple of years ago. And so the pace of investment has picked up a bit. But the biggest message for me is that I'm very happy with the way things are. I'd love to see more investment opportunities coming to the public market. I think we've got a great platform. I'd love to see it used more widely.
I suppose, sorry, just to interject, Paul, I was just referring to I think of all the VCT rule changes, the time limit, 7 years, I think it is, was probably the one that probably is the most restrictive for a lot of companies, as you I think agree. And I wonder whether there's more, you'd rather have a size criteria perhaps than a time limit criteria, maybe make it possible for companies that are under a certain size, market cap or value, to continue to use those reliefs or get VCT money in. I just think that change has been, we've seen quite a few instances where it's made it quite difficult for what remains quite small companies in many cases to actually avail themselves of VCT money.
Yeah.
And technology, sometimes, I know that there are other categories, but sometimes, categorizing companies into which sector or subsector they fit into under the VC rules is quite complicated. And then, if a company doesn't fit into one of the ones which allows them more time, that sort of casts them aside from a VCT perspective. So it's just that 7-year rule. I think that's the one that I would highlight as probably the most prohibitive.
Maybe at this point, I might remind our viewers that they can submit questions via the Q&A button. There's quite a few coming in through now. One of which relates to IHT relief on AIM shares, and we'll have a quick roundtable. The simple question is the abolition of that relief only a matter of time? Let's have an optimistic answer from Marcus first.
Well, it's been in existence since AIM was launched in '95. Hopefully, some of the arguments that I and the rest of the panel have put forward today have been listened to over the years, and policymakers recognise the big benefit, and also just the amount of capital that flows into the market for a relatively small cost. And Andy, I know you've done some analysis on this, but I think one of the really important things about BPR, in contrast to some of the other tax breaks where the break happens up front, is that actually you do need to die for your estate to claim the tax break. So a lot of people will invest but never actually claim the relief. So in that sense, it is a very, very efficient tax break. So hopefully, no, it's not a matter of time at all.
Yeah, Drew, around for a long time.
I agree with Marcus. I think the argument perhaps we've got to make more sort of public as a community is the cost benefit analysis, and perhaps it's not understood enough. I mean, I think it is understood in the community, but perhaps not enough outside of people like ourselves. The cost is quite small for the reasons Marcus just set out. And the benefit is huge. In fact, it's actually so huge, you can almost, the trickle-down effect, it's quite hard to calculate because it's almost infinite in a certain sense. So I think it could be very, very damaging to remove it without thinking about the impact on all those benefits.
Well, I think I know which way your heart is going. What about your brain?
Well, I mean, the legislation has been around for a long time. It goes back to the Inheritance Tax Act of 1984. And clearly, it wasn't invented for this purpose. And there will be questions will continue to circulate around: is that act still fit for purpose? And I don't think, I think it'd be unrealistic to think, well, that's going to go away. And that's why we keep getting comments, and the question keeps coming back. I mean, I sort of rather disagreed with the Office of Tax Simplification's paper last year, which seemed to sort of take the premise, well, of course they're just concerned with simplification, but they sort of took it as read that the act was doing what it was intended to do and was fit for purpose, but this AIM stuff was somehow unnecessary or on top of that. I mean, to me, it's abundantly clear that that what it's doing on AIM is really effective and creating a lot of value. I'm less clear about the value that it creates elsewhere, and it is an old piece of legislation. I think it is going to carry on being looked at. I mean, I hope if it is ever reformed that there's a recognition that actually this is really good value for money on AIM. What it's doing, it's creating an incredibly valuable dynamic stock market, probably the best stock market for companies of this size in the world. Why would you not want that? So I hope that in a way the discussion takes that kind of form when people look at it, and if it does get changed, that actually this part of it is preserved. even if that's to be in a different piece of legislation.
And a question has come in, Marcus, just for you on this. Someone inquiring whether there must be regular dialogue between AIM and HMRC where decisions on qualifying shares are taken. Is there any way of extending that and publicising it?
Yeah, and this is a question that's cropped up many times over the years. I think that the big challenge is that companies change over time, and so a company that could have been qualifying at the point of investment, it may well not be at the point that the tax relief is claimed. So, I think the industry, there's enough broad guidance about the sectors that qualify, and enough industry guidance that gives a pretty good level of certainty. I think trying to take that to the next level and give cast iron guarantees, not just at this point today, but bearing in mind that investors are investing for an absolute minimum of 2 years to claim business property relief, that's a real challenge.
Yeah, and another one on the scale or the market cap threshold for the relief. Is there an argument for putting a limit of, say, $500 million on it, so that the relief is more applied while companies are in their early growth stage, or tapering it down thereafter?
Well, I think one of the lovely things about BPR, the kind of qualification criteria that we just discussed aside, is actually the simplicity. And so I think, to my mind, as soon as you start putting market cap thresholds or any other type of size thresholds, there are inevitably going to be unintended consequences and unnecessary volatility that's created, or even potentially a cap on growth. And the whole point of some of these incentives is to stimulate growth, not put a cap on them. And for a lot of AIM companies, market cap and valuation can fluctuate quite significantly and can be only one indicator of the underlying growth of a business. So it sort of worries me a little bit when people start talking about market cap thresholds for exactly those reasons.
Yeah. And like a consummate professional, Marcus, you've answered another question before I'd even asked it there, where it was just an inquiry about whether the agenda in the current economic climate should be much more focused on employment. But again, I think all the points that we've been making and case studies that we've cited about businesses that have been incentivized to come onto AIM, to use the public markets, raise capital, expand, hire more people, generate more tax for the Treasury, do cover that bull point in entirety.
To that there, Andy. One of the other massive benefits of AIM and kind of unique characteristics compared to most other growth markets that tend to be both domestic and dominated by a very small number of sectors is that AIM has always been a very broad church of companies, both in terms of size, jurisdiction, sector. And clearly, some companies will employ a lot of people, but other very innovative businesses, may well not have that many employees. Look at some of the biotechs that have been, a central part of, the response to COVID. Some of those will be labs with, great IP and technology, but maybe not that many employees. So, I think, any one sort of growth factor in isolation sort of only tells a very small part of the AIM story.
Yeah, and we've had another very good question. I'm afraid it includes the Brexit word, but in a constructive sense, that as we look ahead, we've already celebrated the fact that AIM is a very international marketplace, given the domicile of some of its constituents. Amati Global has the word global in its name for a very good reason. And so if we move into a complicated, well, it's bound to be a complicated Brexit scenario, but what are the opportunities or the steps to make AIM even more attractive to non-resident domicile companies?
the international AIM has been international for a very long time, and again, this has been part of the long windy road of learning how to deal with international listings. Hasn't been easy, I would say. When an overseas company lists on AIM, which many do, I'd say in the early days, it was very easy to overlook how different the legal contexts were between London and other geographies. And so I think when I think back to the kind of the extraordinary array of kind of Chinese companies that came to London in 2005, 6, 7, 8, which was a complete disaster. Because and there was no kind of legal match between our geography and the Chinese. So that at the small level of the small company, it just simply didn't work. And then there are sometimes you see the phenomenon where a company can't raise money in its own country because it's not very good. And the entrepreneur behind it is known to be pretty duff and comes, thinks, well, nobody knows me in London. I know how to tell a great story. I can go there and raise money. Yes, that's happened a lot. And so there is this sort of, there's an extra obstacle to overcome to list an overseas business in London, which is that it's that much harder to build trust. It's harder to do the ongoing investor relations. And there's quite a lot of history which hasn't been great. That said, we are now. I think it's a set of processes which has got better, and there are many companies that are dual listed between London and Canada, between London and Australia, very successfully. And sometimes the regulatory systems rub up against each other a little bit awkwardly. Sometimes the practices of brokers in Canada strike us in London as not great, but and I'm sure vice versa. It's just they have ways of doing things and we have ways of doing things, and they're different. But none of that really matters as long as the companies themselves are good. At the end of the day, stock markets are there to provide capital to the best businesses, and we can overcome all the other obstacles, but we have to be slightly cautious about getting too adventurous with it. And I mean, in answer to the question that's been asked, it's less usual for these international listings for the entrepreneurs to actually move to the UK. There's obviously no requirement to do that. With VCT investments, there is a requirement to have a UK presence, and often, what happens is the company does set up in the UK market, which otherwise wouldn't have done, and that's great. But for international listings, that's less common. I have seen it happen where the entrepreneur moves over. And it's also very good when it happens, but it's probably not the norm. But I do think one of the things that the things that the UK has to export to the world is actually its legal system, and and that is right at the heart of the London stock market. We have a high level of trust in the market that's built up. We have a sort of high standards of behaviour really, where when people say they're going to do something, you expect them to do it. And in general, that's been upheld. Obviously there are always exceptions to this, but I'd say looking internationally, that's one of the great strengths of London, and it's one reason why companies will come and want to list in London, because it has that kind of reputation.
I'm sure that goes Drew.
So just to add to that, Andy, I agree with Paul, but I think we would always encourage international companies moving to London to try and maybe reconvene themselves into a jurisdiction that where you have the panel, the protections of the code will be offered to investors, because people do see that in London as vital, I think, and again, as well understood what those protections are. So, in terms of helping international business, I think there's quite a bit of work to be done sometimes in terms of explaining why they should think about re-domiciling to jurisdiction, which is subject to the code, UK Companies Act. These are all things I think investors do look for as part of the packaging for an IPO in the UK.
Well, I'd also just say, I mean, there are many elements to the international nature of AIM. And I mentioned earlier some of the export stats, so UK companies exporting internationally. I'm reliably ensured that AIM companies have sales to 205 countries globally. And I questioned that because I didn't actually know that there were 205 countries. But that's another sort of indication of the breadth of the international kind of nature of AIM companies. But also, I think one of the other things that's happened over the last 10, certainly 5 years, is the international flows of capital into not just AIM, but London more broadly. And if you look at the share registers of particularly some of the larger AIM companies, you can often find 30–40% of those shareholders being international, North American based investors. So it is becoming much more international on a number of levels, not just the number of international companies floating.
That's very, very, very important points made again there. I think just to wrap up, trying to take again a constructive angle to this. If Rishi is watching the recording of this event, and he's still looking for a few billion here or there, can I have just quick comments from some of the alternatives that have been raised? VAT increases, wealth tax, CGT being moved in parallel to income tax rates, all of which seem quite unpalatable. And perhaps more palatably, if either any of you have suggestions for getting money from people who are avoiding paying it at the moment, that maybe looking at the tax havens, et cetera, and how to apply tax rates there. So just thoughts on that from all of you. Eeny, meeny, miny, go. Why don't you go first, Paul?
Yes, thank you. I think you're right. We do need to consider, well, how is the UK going to pay back some of the money it's been borrowing this year? I mean, I would certainly look. I personally, I'm not an international tax expert, but my gut would tell me that there's a lot more that could be done in relation to sort of tax haven phenomenon, which has grown so massively, and because most of us are blind to it, we don't really study it, we don't look at it, we just massively underestimate how much money has moved offshore to those kind of destinations. I mean, I would look at the idea of, if you're not paying tax in your home, capital gains tax in your home jurisdiction, then pay it in the UK. If you're investing in the UK, you should kind of pay capital gains tax here alongside everyone else. I mean, so in other words, taxing money that makes use of the London financial system, but is non-resident there and is not paying, is resident in a tax-free zone. I mean, there's a lot more that could be said about that, and it does go way beyond my knowledge. But I think that would be, if I was the Chancellor, that would be quite high at my agenda to really try and make some progress with that. There's obviously the much talked about idea of levelling up the VAT playing field for companies that operate without paying VAT because they can claim their products manufactured in a non-VAT jurisdiction. Amazon's done a lot of that, and this is much debated, and I think we could really do with seeing some progress on that front. I think we could see significant amounts of tax generated from that. And then at the back of my mind, I think there's an ongoing question over whether debt should be so favourably tax treated relative to equity investment. I'm really quite sceptical about that, and I don't want to make sweeping statements without having studied this more, but I suspect that there's a good case to make for not deducting the cost of debt from tax bills, and in many ways that might encourage a sort of healthier type of financing around the world. Where companies tend to run with too much debt because it's so tax advantaged. Why do we allow that? And maybe setting a threshold above which you can't, maybe instead of saying no tax can be deducted, no interest payments can be deducted, say none above a certain threshold could be deducted, so you're not, at least not incentivizing excessive borrowing. And I would add to that, one reason why I think that hasn't happened is because our friends and colleagues in the private equity industry are phenomenal at putting the case for the other side and very influential. But I think really that's where I would go looking if I wanted to raise some more tax.
Yeah, again, very important point. I think the statistics there, I believe in the SME environment, I was amazed to find that 80% of their funding for ostensibly risk growth vehicles is debt. and you're right, at a stage when you're maybe pre-revenue or pre-profit, certainly.
I mean,
There
yeah,
are other ways.
I don't want to bang on about it too much, but it makes me really cross actually when, why should a company get acquired out of the public markets, and then the finances are restructured and the next day it no longer pays tax? And why should that be? I mean, whether that happens now, I don't 100% know. I know the law has changed in this area over the last few years, so it happens less, and it happens to a lesser extent than it used to. But this is the direction of travel, and I think we could go further with it.
Dru, any pockets of capital for the Chancellor to address?
My view on taxation is that we've got to, not in relation to what we've been talking about, but just generally across the UK, we've got a very, very complicated tax code. And so my view would be, use the opportunity, if you see it as that, to simplify, across the board. And I think you'll find, well, it would be my thesis, that if you simplify, in some cases reduce rates, people are more likely to pay, which might then self-regulate the non-paying point that others have made. Because, as you push up rates, these studies were done in the 80s, you collect less. So, simplify, bring down. You just look at income tax, just as an example. We've got NI, we've got phasing out of primary allowances, you've got pension taxes, which are, no one can work out how to fill in the forms. I mean, it's very, very complicated. And, having a large tax advisory industry is not a useful use of resources in the UK. I mean, I know that the accountants would be aghast at hearing it, but that's the reality. They could usefully be doing other things, I think. So but if there's one tax that I think is easy to self-regulate, because those are the best, it's probably VAT. And you only have to put up VAT or change VAT by very small amounts to collect a large amount of money. And maybe there should be more zero rating in terms of essential products, food, clothing, etc. But on the whole, luxury goods, maybe there should be higher VAT. So yeah, those are my ideas.
Last word, Marcus?
Yeah, I completely agree with Paul about tax deductibility of debt versus equity being taxed 4 times. I think events of the last 4 or 5 months have demonstrated the challenge for companies that are very highly leveraged. So the more that we can do, both from a tax, but more structurally from a debt perspective, to reduce the economy's reliance on debt, the better. I think that the final comment, though, would just be, rather than focusing on tax, actually, I think what we need to continue to focus on, which has very much been the subject of this webinar, is growth. And how do we generate growth? And we've got some fantastic assets in this country, great IP, brilliant universities, very high levels of startups. We just need to make sure that those businesses, continue to grow and generate jobs, employment, innovation.
Yeah, good positive note on which to finish. Thank you to our audience. Very, very interesting range of questions, and many thanks to you 3 gentlemen for carving out the time. Still very busy for all of us in July, and I'm sure that a lot of useful material here for continuing to fight the good fight for small companies, for AIM, and for growth. Take care, everyone.